What's up, guys? John here. Freddie Mac is scheduled to issue a $2 trillion stimulus to tens of millions of American homeowners over the next several months to delay any type of real housing crash. Think about this. A $2 trillion line of credit. They're saying it's the secondary mortgage market that they want to offer a line of credit, a helping hand to American homeowners to tap into their equity. Now, that might be true, or there could be something else going on here, something we need to pay very, very close attention to. Because the more that you look at the facts and the data, the more you realize none of this makes any sense. For example, if we're in this great housing market, why are they no longer reporting on VA foreclosures, veteran home loan foreclosures? Why are they no longer reporting this? FHA home loans. If you can't make your payment, they will reduce your monthly payment 25% so they don't have to report it as a delinquent mortgage. Right? We have record high credit card debt, record high mortgage debt.
Debt crisis in our country. Americans owe a record amount on their credit cards.
Balance is climbing to a record high of over $1 trillion.
You're seeing bankruptcies skyrocketing, layoffs really taking off.
Filing for bankruptcy now at the fastest rate since 2020.
Bed Bath & Beyond filed this year, Party City filed, Vice Media, Instant Pot, the list really goes on.
Talking about bank failures, all these different problems. We're in this great economy, and now they want to bring forward a $2 trillion line of credit and stimulus package to help American homeowners. Now, this could be true, or it could be a major setup that tens of millions of Americans are going to be pushed into that could cost them their home. Now, I'm going to break this down for you and show you what's going on because none of it makes any sense. Let me give you something here. Look at this. Newsweek, 2 days ago, they said nearly half of all states report drops last month, right? Half of all states report drops. Now, 2 days ago right here, it says, this is Redfin, for the first time in nearly 2 years, there's no major American metro where home prices are falling, right? This is the first time in 2 years no home prices are falling, but Newsweek says the complete opposite. Then Redfin, the same company, I'll pull this down and you can see the URL, redfin.com. Then here on fortune.com, the CEO of Redfin says the economy might be booming, but housing is in a recession. How can housing be in a recession if home prices are not dropping, right? It says top real estate CEO says he's never seen anything like it in 20 years. So what he's saying is it's worse than 2008. 2008 was what, 13 years ago, 15 years ago, right? So you start to look at this, you're like, all right, well, what's really going on here, right? Are we walking into something really, really big? I think we really are. I think this is going to be far greater than 2008. I think we're going to see millions of people taking these loans and losing everything. At least it could be. According to what I'm going to show you here in a second. Please hit the like button. When you hit the like button, YouTube will share this content to educate the people about what's going on in America's housing market and economy. And if you'd like to fix your credit to position yourself what I believe is going to be the greatest wealth transfer and the greatest rug pull in American history, we would love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free call for Monday. Take a look at this. So, it's really shocking. Nobody could predicted this. The mortgage reform that will unleash the next big stimulus. Now, they said, what if I told you there would be an unprecedented stimulus injection in the U.S. economy that will cost the government nothing and will not add a dollar to the national deficit? So, they're going to offer trillions of dollars in stimulus, and it's not going to cost American taxpayers nothing, and it won't cost the government anything, right? It's just going to come out of thin air. They said, as early as this summer, a proposed move could begin to unleash almost $1 trillion into consumers' wallets. By the autumn, it could be on its way to $2 trillion. Last month, the government-sponsored mortgage finance agency, Freddie Mac, filed a proposal with a regulator, the Federal Housing Finance Agency, to enter into the secondary mortgage market, otherwise known as home equity lines of credit. This was a smart move by Freddie, and the FHFA will do a lot of good by approving it. Despite more than $32 trillion in equity in homeowners' balance sheets, very little of it has been tapped through home equity loans. Now, they're trying to tap into this $32 trillion in equity. Now, I personally don't think that there's $32 trillion in equity. I don't think there's anywhere near that. Look at this, for example. And by the way, I don't trust estimates. I don't trust, the Redfin estimates of what they tell you your home is worth. All that. You have to look at it. For example, look at Downey, California, right? Downey, California, they say which is in LA, right? They say the median income is $37,000. Median household income, $77,000. Let's just say it's 80 grand, right? You'd have to afford the average, comfortably inside of your budget. You're probably somewhere on the higher end, you're 800, 900. That's at $275,000 in income, right? Now, and this is with no debt at all and $50,000 down. Let's say you're at $80,000, right? $80,000, you can afford a $250,000 home. If you look at Downey, all these homes, $600,000 is the cheapest, but there's a lot of homes, $700,000. There's even some, in the millions, $3.5 million, right? You look at this, there's no homes anywhere even in the 500s. Not a single home in the 500s. There's no search filters, by the way. So there's no search filters, not a single home for 500 grand, right? So how can this be accurate if they're saying that everyone has all this equity in their homes? Could that be true? Or could we see another situation here that I think is more likely? What I think is very likely going to happen here is I believe many Americans are tapped out financially. They don't have much money. Inflation is brutal, and they need to pay their loans, and they need to find a way to hold on. They don't want to sell their homes. They don't want to let go of the 2, 3, 4% mortgage rate, and so they need to hold on for dear life. And so taking out a home equity line of credit could be that, that life jacket that they need. And so they take out this home equity line of credit, hypothetically. And they take this out saying, you know what, I think mortgage rate's going to go down in a year or 2 years. And I'll be able to tap into a better, vehicle financing and pay back this line of credit and make it. Or could we see rates much higher for longer? And at that point, that rate goes from the 4% introductory APR or 5%, whatever they offer, and then it goes to 8, 9, or 10%. And now they're looking at this loan saying, you know what, this puts me out of business. I can't afford this home. I need to go rent. I need to walk away from this property. Now, I think that's a high probability. I've been talking about this, saying that I don't think rates are going to be cut anytime soon. I've been saying this for a very, very long time. I think rates are going to be much higher for longer. In fact, Apollo just came out yesterday saying the Fed won't cut interest rates this year, right? I've been saying this, right? They're not going to cut rates. And so if a home equity line of credit hypothetically is for 2 years, and they're not going to cut rates this year, if they don't cut rates next year, people that take out these loans could be in serious trouble. Now, it's like the more you look into this, the more you realize something extremely, in my opinion, shady is going on. 2007, just before the financial crisis, there was more than $700 billion in home equity loans. Today, there's roughly $350 billion. So is that true? Is there only $350 billion in home equity loans and there was literally there's 2x in 2007? Well, let's look at Google Trends, the interest for people searching for HELOCs. This is 2008, 2009, 2010. Here's where we're at right now. So you tell me, you think there's 2 times the amount of activity in home equity loans back then than there is right now? According to search, it's not true, right? According to search, it's not true. But very interesting other things that are unfolding right now. For example, you had JP Morgan Chase and Wells Fargo. They've stopped or suspended home equity loans and home equity lines of credit applications. And so they're pulling back. And so they're basically building out this massive pool of demand for lines of credit. Now, I'm sure a lot of people have taken out certain loans and certain, lines of credit to be able to weather the storm during this period. A lot of people have taken them. But I think that what we're going to start to see is this get out of control. And when I'm going to show you how this is all structured because it's absolutely crazy. Home prices have risen, and this is how Wall Street is basically going to be taking over homes. Home prices have risen by more than 70% since then. So why have home equity loans helped? After the financial crisis, banks have actively taken down their mortgage exposure. Bank of America, for example, has cut its home equity loan portfolio from more than $150 billion in 2009 to $25 billion. In 2022, more than 50% of home loan originated from non-traditional operators. These bank companies don't have the balance sheets to hold loans as banks had traditionally done. So unless they can sell these loans, they originate to Freddie, its fellow housing agencies, Fannie or Ginnie, or private investors. They don't originate them. There's a robust and well-oiled mortgage-backed securities machine for first mortgages in which Fannie, Freddie, or Ginnie buys mortgages, pools them, and sells them to mortgage-backed securities to private investors on the open market facilitated by Wall Street firms. Now, they predict in 5.5 years, that 40% of all single-family homes in America will be owned by institutional investors. Now, this is just a belief that I have. Could be wrong. But if Wall Street is buying a lot of these mortgage-backed securities and they're buying and really supporting a lot of these new loans that people are going to be taking on these homes, what happens when people default? Who is going to be the one who's going to be the beneficiary of the properties that are, in second positions? Because home equity lines of credit generally are a second position, or in that range. It's not going to be a first position if it's a home equity loan in most cases. Now, what would happen? Wall Street would have some type of interest in these properties, I would imagine. And they're not just issuing these loans with no collateral. Since this process dramatically increases liquidity in the market, none of this liquidity exists in the secondary mortgage market. The Freddie Mac proposal could change all that and could not come at a better time. Most people in the U.S. are feeling the sting of persistent inflation, but older Americans living on fixed income have been hit particularly hard. Insurance costs and for homeowners have risen well over 11% over 3 years. Now, 11% over 3 years, I would argue it's a lot more than that, and especially in a lot of markets like California, where a lot of insurance providers are pulling out of the state. Florida, Texas, a lot of places where people have moved the last couple of years, they're seeing rate hikes well above 11%. U.S. property taxes revenue have risen 26% over the past 3 years. So you think about this. They prop up the housing market. They put all this money into the housing market through all these loans. Property taxes then continue to remain elevated. They extract so much cash and capital from these homeowners. Insurance premiums skyrocket. And, it's all because this facade that the housing market is robust and strong. I don't see how the housing market is robust and strong when, someone making $80,000 a year can only afford a $250,000 home. Even, the average home price in America is $419,000. This is based on your income. A house in this range may stretch your budget. So someone, right around here, $318,000 for someone making $80,000. If you're making $150,000, you're at $500,000. $150,000, you're probably in that $500 to $600 range with $50,000 down, but probably more comfortably around $400 or $420, making $150,000 a year, right? Most homes are $500,000, $600,000, $700,000. Imagine what's going to happen when they start issuing all these loans and lines of credit on these properties. It's going to be a storm. That's what I think is going to happen, a storm. I think there's going to be possibly a surge where a lot of people are going to be taking out these loans, holding onto these properties for dear life, holding on, hoping that the economy turns around. But I personally think the economy is going to get worse, because you just start to look at the writing on the wall. CNBC reported just a couple days ago, they're talking about hundreds of banks that are likely going to go down. The Bank Term Funding Program that came out, or that expired March 11th, you have 1,804 banks took out $161.5 billion in loans that they have to pay back, over the next 10 months. What happened during that period after Silicon Valley Bank fell and, Signature Bank and First Republic and PacWest got acquired by Bank of California and all that, Credit Suisse, all those problems, they came out with this Bank Term Funding Program. And they said, look, I know all you banks are sitting on a lot of losses, but we'll buy, the loss that you have as if it's 100% value. There's no losses at all. We'll give you the loan. But on the flip side, this loan's only for 1 year. And when you pay us back, you have to pay us back the 100%. So these banks are in worse positions today than they were a year or two ago. And so you start to look at this situation, it's all ramping up to a really, really big liquidity event, all of which I believe is going to have a negative net impact on the housing market, because, home value is only worth what a buyer is willing to pay. And if buyers can't afford cheap debt and their incomes are not going to skyrocket, then how are values going to stay, where Zillow and where they're saying that they are? I don't think so. I think we're walking into a really, really, really big housing crisis that is going to be unraveling in the next year or two. What do you think about this situation? Drop below. Let's have a conversation about this. If you'd like to fix your credit to position yourself, what I believe is going to be the greatest rug pull in American history, it started in, about 4 years ago, it's going to ramp up this year and next. So make sure your credit score is in line with your goals. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any issue at all in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free call for Monday. I'll catch you next video.